This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. It is Tuesday, February the 12th, 2013. I'm Gord Long at GordonTLong.com. I have with me this morning Andrew Joseph, the editor and publisher of Triggers CA and principal of Golden Phi. Welcome, Andrew.
Morning, Gordon. Thank you for having me.
Before we begin, Andrew, I just need to cover off some mechanics here for our listeners. I would ask our listeners, open your slide viewer to full screen viewing, or you'll not be able to see some of the detail in the slides that we'll be discussing here this morning. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Andrew, what I wanted to highlight this morning in the limited time we have available is first share with our listeners some macro observations that I've been seeing. Then some general comments that I've highlighted here on this chart. Consumer confidence plunged this month in the United States, and it has been falling in Europe and around the world, and the latest Nielsen Global Consumer Confidence Report that I'm a big hawk on, and is actually not that well followed by the analyst community, lays out a clear global shift in sentiment towards reduced consumption, and I'm going to show that chart here in a few minutes. On the other hand, we have levels of investor euphoria, which is likely not to sustain itself and is proven historically to be subject to shocks and fear triggered from unexpected events. And as a matter of fact, it's at record levels of euphoria. So there's just a complete disconnect going on here. And the technical analytics and economic indicators showing just a growing number of divergences that are in most cases, again, at extreme levels. Q4 earnings are a serious disappointment, but analysts are still in denial with elevated expectations for 2013. Top-line growth is under pressure, with it now showing in margin erosion. And again, I'll show these charts as we go through them a little later. Our earnings have been held up by financial adjustments. That's the politest word I can use. Adjustments that low interest rates allow, off-balance sheet accounting foster, pension accounting incents, and lack of organic growth forces. And it's just a natural consequence here. The orchestrated collapse in the yen is artificially increasing the value of the euro and temporarily shoring up the U.S. dollar. To me, the market is pricing in a major global reflation due to the reigniting of the Japanese carry trade. And that's the chart here I have over on the right hand, which is a daily chart of the yen-euro cross. And this is quite dramatic. You actually chart this as part of your charting service. You're quite familiar with this particular cross, as you are with the major crosses.
Yeah, we do this 2 times a week on a daily and an hourly level, update this. But what's interesting about the chart you're showing here on the daily, you notice the spike on the right-hand side, it completely blew any of the technicals away on the left-hand side. You can see some toppings when we were coming down that were just blown right through, no stopping. And if you look at this on a weekly level, what you see is actually that we're just getting started with this potentially, and it can go a heck of a lot higher. I
lay these out in our drivers section of the MATA document, which is, as most of our listeners are familiar, this is the key handoff that we use to your service at Triggers to integrate the drivers and how they're moving as we take it right down to the equity markets. This is a significant event. This is changing a lot of the dynamics, and it's flowing across specifically to the bond market, certainly in the high grade, but very much in the high yield. Used to be called the junk market. To me, the bond bubble continues to be a worry, especially, as I said, in this high-yield credit arena. There's a serious chance of a shock occurring here in parallel with the Forex adjustments. I don't have a chance to go into this in significance of what is going on here, but I posted yesterday on Monday, February 11th, on our tipping points page a significant number of charts showing what I'm referring to. And if you're listening to this tape at a later date, we have archives by date where you can go and find them. This is to me, very important of what's going on in the credit markets today, because it's actually a triggering in previous sell-offs where it stemmed. And there's a relationship between high yield and the Euro's STOXX market parallels when you have divergences, and we have those triggering sell signals happening right now. And the amount of outflows that happened here last week from high yield is confirming that to me. So that's why I think when we get into some of the charts later on, what reinforces some of the targets that we've established, I published in my MATA document here this week, and I know you will be in your triggers document as it's about to come out.
Speaking about the other instruments, to your point there, we can see the bottom of this chart and the turn and the dramatic rise. That's seen across all the other charts as well, too. That just didn't happen all by itself. It is definitely affecting everything else that's going on technically.
Exactly. I can't help feeling, Andrew, and I'm a little older than you, but this reminds me of the summer of 1987. It also reminds me of January of 2000. That was, remember, the dot-com exploded in April of 2000, or the summer of 2007. Eerily the same, all three. All of them had this in common. The market made no sense. It had disconnected from reality, but it just kept going up. The public and professionals they all felt like they were forced to participate. And we all know all three scenarios ended badly, but it just kept going, and it just made no sense. And the chart here is going back to the era of irrational exuberance, for those that recall it, during the Greenspan era, and shows a clear head and shoulders pattern emerging, and that the advances, maybe more importantly, or as importantly, the advances are becoming more muted relative to each other. So the reinflation period we went through in the 2000s, which gave us our head at 2007, this whole rally that we've had here with, I'll call it the quantitative easing rally and global coordinated, massive, unlimited, uncapped liquidities. Clearly, all of this is running its course and is losing momentum.
You can see on the chart too that we were just looking at. The waves are getting smaller. It's obviously going to be coming to an end.
That's why I wanted to show these, Andrew, is because trying to call the little twists and turns really is a fool's game. If you can see the bigger swings and the bigger moves, you got time to take them, get yourself lined up, and let it unfold. Otherwise, you just get shaken out on it. This chart of the U.S. stock market capitalization as a percentage of nominal GDP goes back even further than the one I was just showing, and clearly shows two major channels. The first is a long-term trend channel, and the other is a post-dot-com, what I'll call a corrective or regression channel. And the area enclosed between the two channels appears to be, a logical target area. And I'm going to explain why that is more than just logical here in a couple charts. But the dramatic rise in the post-gold standard era and the financialization of America, with financial stocks becoming 44% of equity markets, 30% of profits, nearly 6% of GDP, and you see that labeled here as we just spike right up. But it then followed with what I call the deindustrialization of America, with outsourcing, downsizing, right-sizing, and somewhere between 44 and 47,000 manufacturing facilities leaving the country, leaving the United States. And this chart suggests that sometime over the next 1 to 4 years, we're going to see a major reduction in market capitalization, or an explosion in economic growth. And I think that the latter, to me, is a very low probability. So, it makes sense that there's a regression. The macros are suggesting that what we should be seeing. This chart shows the 2-year change in the stock market capitalization. Again, I'm focusing on total market capitalization as a percentage of nominal GDP, and we are seeing a pattern emerge, as you can see, of lower highs and higher lows during the periods of adjustment, during the periods of euphoria and panic as we rotate back and forth. There's a clear cyclical pattern evident here as we go from euphoria to fear and back. And the chart suggests, at least to me, there's a very high probability of more fear in the short term as we go back to that center line or possibly even lower into it and stay within this triangle over on the right-hand side. If you overlay that with the realities of the current U.S. fiscal cliff, the debt ceiling, the budget discussions, you can draw some supporting conclusions to that market capitalization charts. You know, this whole sequestration, spending caps, and reduced war spending will together reduce real federal consumption and gross investment by 11% over the next 2 years. I mean, that's dramatic. And that's a very big drop to a very weak economy. Clearly, that's not going to happen. I don't care what's going on in Washington. They will kick the can down the road. They just will. As Reuters pointed out in a recent feature article, even a small change or reduced or flat is going to have significant impact to the United States when we start withdrawing the rate of increases in spending. Because right now, government's 26% of the GDP, 165 million people are living off transfer payments from the government, and 70% of our country is a consumption economy, and it will show in the market capitalization. Does it make sense to you, Andrew, these charts?
Yes, very much so. They all overlap very nicely and flowing. They're telling a very consistent story as far as I can see.
I wanted to put this into perspective because as we drill down into some of the detail I want to share this morning, you'll have a framework on which to hang some of this meat on, because it does make sense. But if you get down to the details too quickly, you can sometimes get a little confused with it. And that's why, for example, what I'm seeing with the consumer confidence, this is a dramatic divergence here between consumer confidence and what's happening with the S&P. It had been going up, and it just recently plummeted and getting worse at a fairly significant rate. And it would appear that to me that the hikes in taxes on 77% of Americans due to the non-renewal of the payroll tax holiday that was heralded as a success has dented confidence just a little, and I think it's going to do even more damage. And as the stock market moves to all-time nominal highs, in many cases, consumer confidence, which has literally, as I said, just fallen off a cliff, and the Conference Board printed it at its worst level in 13 months. So all those 2012 gains are gone, one month. You know, and for every income levels, you know, except those earning under $15,000, confidence plunged most within the $35,000 to $50,000 bracket. Those are ones that do a lot of the consumable consumption spending, you know, at the Walmarts and the Costco's and the BJ's. I mean, that's money is being compressed significantly. And it would appear that the driver of 70% of the U.S. economy is not buying the new normal that is being fed to us daily by the media. Put that into perspective. This chart compares the current situation to the worst events in modern financial history. I keep this in my MATA document regularly just to keep things, again, in perspective. And look at on the bottom, what we're talking about is major events. So we're not only falling and coming down dramatically, we're coming down from already historical low levels. This is a crisis of trust. This is a crisis of confidence. People are starting to lose faith in the system. I may be drawing too big a conclusion, but I sense that that's what's starting to happen here. And it's not just unique, Andrew, to America. I can show the same charts in Europe, but this is the Nielsen Consumer Confidence Report I mentioned earlier. I go into great detail in my reports because it's a very extensive amount of data, but it's worldwide. Every region, all the countries, they're all consumers are pulling back, and it's showing on the left, you know, various categories that they're reducing on. The disposable income is being squeezed around the world. There aren't the jobs. There's no increase in pay in the jobs. They're worried about losing the jobs. And the inflation numbers are bogus. And even if you were to accept the reported inflation numbers, what they misstate is the basket of what people actually spend their money on. We take out gas and we take out food. Well, that's where people spend their money. We don't factor in education, and that's bankrupting Americans right now. We don't put in correct adjustments for what people are paying on medical coverage, in specifically the United States, which is killing people. So the basket that they use for inflation is seriously flawed. Ever mind the inflation numbers that use substitution, histonics, imputation. There's all sorts of statistical games that I've done a lot of work on. It just said it's bogus. But this is a global issue that we have here. I don't know what you're seeing locally.
I know there's a lot of houses for sale on my street. They're not moving very fast these days.
Well, you guys are in for a housing crisis that's coming.
Yeah, I think ours is still to come. We're going to follow you.
Canada did not experience what we've already experienced here in the United States. Switching gears, Andrew, the situation going forward is nothing but awful as negative pre-announcements continue to surge. And I'm showing here the negative pre-announcements as I switch here to talking about earnings. The outlook for profit margins is, frankly, to me, outrageous. The chart on the right is a Goldman chart of the forecasted margin trajectories. Q4 earnings season will be the worst of 2012. Earnings are set to decline 1% year over year, while Q4 earnings are sagging notably 8% lower than pre-earnings season expectation. The incessant ratcheting down of expectations as the season progresses enables an ever more desperate sell side to point to earnings that are beating estimates without pointing out that it's from a lower and lower bar. So, Microsoft and JP Morgan alone accounted for 50% of the beats. But with guidance plunging, Morgan Stanley sees 2013 consensus estimates of $112 massively out of line with reality. Goldman thinks it's significantly overstated. But look at this chart on the right side. I mean, it's absurd. And this is what the PE's expansion are all based on. It's not going to happen. It just simply is not going to happen. I've done a lot of work on PE expansion and margins in my monthly MATA document, but suffices to say we have reached peak margins by any historical measure. And this simple diamond pattern of a consolidation suggests that. Ever in mind the actual Shiller implied PE ratios are also on 10-year running averages of peaked. Andrew, what all this tells me is we're putting in a right shoulder. And as we effectively complete a rising wedge or ending diagonal shown here on the right in red, and both of those are terminal patterns. When they end, that's what we'll talk about, but they're clearly terminal patterns. So it's coming to an end. Head and shoulders, you can see the neckline, which gives you, if in fact this is a correct pattern, then it tells you what kind of projections that you can expect. I've drilled down on this particular chart to show the head and the right shoulder, but shoulders are as much about time as they are price. That's really important to understand. And they're also about volatility. So they're about time and volatility as the bulls and bears, start to battle it out as perceptions change. And that takes time. And we have been witnessing extreme lows of volatility. So you can expect volatility to increase and this shoulder to take time as we move towards the right.
It's interesting, Gordon, about what you were just showing us, the charts there. Both those last two charts that we've just been talking about, we've been watching since I first started publishing triggers back in 2011. And we follow the pattern and it's continued and stayed on course, which is one of the reasons we're pretty confident as to what we're talking about, because it's unfolded for over a great length of period of time, pretty much the way you've predicted. The pattern on this right lift that we're now having, all those ups and downs that you see in there, you've been calling pretty consistently.
That on the leg up and also on the leg up to the head too. It's in the middle. We have been consistent. So I would say going back to 2009, been following a very methodical, because it's all part that we're in a secular bear market right now. And it started in December of 1999 in real terms. And these are all nominal charts. And when you do the work that we do in real dollars, real charts, and we denominate things other than in U.S. dollars, we denominate it in real baskets, it becomes quite clear to see what's happening and how these charts will in fact play it out. Andrew, I have as I drill down on that right shoulder and on that wedge, what our current outlook is, and this is a chart right out of your triggers service. I wonder if you could explain this to our listeners.
Sure. We're looking, as you said, the very top of that wedge and our current market position. Sometime this week, we're actually expecting to get the little pullback, which is the first down arrow we see there. We're up against the wedge formation that you can see at the top, red dotted dotted line. This will be the at least third or fourth time we've hit it now. So we can expect some pullback. Another reason for that is if you take the last low at the bottom to the very first big pullback, the time is exactly about the same as from the lift to now. So they're equal. In other words, there's a 1-to-1 ratio there saying that we have a good chance of having another pullback. And then from there, we have two highs that we're looking at. The parallel lines that you see going across the top of the chart are marking previous highs back in 2008, some significant levels. And so that's one of the reasons they're targets that we're looking for. We're not really sure exactly where in here. There's a couple places with the technicals are saying that the market will move to. Either way, we're looking for another lift, and then we'll start a significant down.
Could you explain the times that you have labeled there vertically, Andrew?
Yeah, the first one you'll see from the down arrow is actually March 1st. We're thinking sometime that this will be bouncing prior to then. Between now and then is when the low will come in there. And then we'll lift up until March 15th, or April 15th. That's where the two top, projections are sitting on. The first one is March 15th and the next one is April 15th. And there's some significant events around those 2 dates, are there not, Gord?
Yeah, well, March 15th is quadruple witch, which has been a predominant key date as options and the whole derivative markets readjust on a quarterly basis. Also, that's the Ides of March, which is always has some other significance technically in the charts. And then April 15th, usually that's when the tax monies, whether they're IRAs, 401ks, RSPs, are usually deposited. That's why when the dot-com bubble, it wasn't until after April 15th that we really started to see some of the downs when all the money had been placed.
Coincidentally, we're having some technicals showing with some timing indicators of things that are really happening that support the fact that we may get a turnaround and this may be the top here.
Right, exactly. So, it shows the right shoulder, shows volatility, it shows a clear topping pattern, the dates seem to make sense. It passes a set of logic. I believe the down probably is somewhere in the 1465, relatively shallow, 1465 in the S&P. My feeling is the upper end on the bounce is something in the 1565. But one of the things that we do know, Andrew, is your high probability trading zones, which are the two green boxes. How we get to them can change.
Yes.
What we've consistently found, and your statistics bear it out, we arrive at one of those two boxes.
Yeah, we're not always sure of the exact path, but we usually get to one of them.
Do you want to quote some of the statistics?
Sure, Gordon. We are talking earlier about the Euro yen cross, and we've made 69 targets, high probability target zones of where we believe the market was going to go to. And of those 69, 65 have hit. Only 4 actually went someplace else where we weren't thinking. Again, another one we watch is SPX, obviously, and we've made 43 of those calls, and this is since July of 2012 to February 1st. And of the 43 calls on the SPX, 37 have hit. We're also watching the US dollar, gold, and oil, as well as VIX. And we publish these twice a week, and that's where we're getting our statistics from. And more often than not, like I said, it's upwards now 92% that the market will move to one of these technical areas that we identify.
So yeah, that's what's really working effectively between our macro drivers, which are telling us key dates, key movements, and the integration between the Forex, the bonds, the various forms of equity markets, precious metals included. And then you overlay it with technical analysis where we're trying to identify the high probability zone that it's going to go to.
And it all lines up.
And when we find that they all line up, we end up with a fairly strong level of confidence. And no guarantees, but
sure,
this is a game of probabilities. Last chart I have, Andrew, is the arrow that you showed on the right on your chart, down.
My big down, yeah.
The big down is the first one of the black down arrows down, and then there's another one that goes back up. So I see that beginnings of a fairly significant sell-off, but it will be, I'll call, a major scare in 2013. And then I'm showing that it's a back up. It may not, it probably will be a double top. It may be a marginally higher, don't know, but it'll be pretty close in there. And that's based on a significant assumption that the rebound is based on a massive globally coordinated actions which give us this double top later in the year. Without a massive globally coordinated action, all bets are off, and this gets ugly fast. But I think the central banks still have another card up their sleeve that they likely don't want to ever have to play. Hope they'll never have to play it, but are going to be forced to play it. And it'll be in reaction as the politicians are screaming for something to be done. And that card will likely trigger hyperinflation expectations if they play it and happen in time before we get a tremendous amount of counterparty sell-off and collateral contagion. But there will be a big scare coming here in the second half, the end of Q2 of this year. The right shoulder will have been put in. The V that I'm showing here is actually part of building a final rounded top as we are on the right-hand side of the ellipse. So any comments, Andrew, on that chart?
Yeah, well, this is, again, something we've been following now for, like I said, our first publication in May of 2011 showed this topping that we're seeing here with the ellipse. And now, today, we're seeing that we're actually at the top, and so we'll see if it holds. There's going to be a good chance that it will. And then, as you said, this will take a little bit of time. It's not just going to plunge right off. We have to come over to the right-hand side, and that'll probably take another year or two before we start to see where the market really dumps.
Yeah, these ellipses are tremendously indicative and it performed pretty well. It shows us going above the ellipse. I'm showing the very original ones we drew. In actual fact, if you see along the left-hand side of that ellipse, there were some numbers that were a little bit through. If I adjusted it to make sure they were definitely inside the ellipse, I think it would extend up and bring in the tops, so we'd be within the ellipse. But I didn't want to play games with trying to fit it. It's good enough for what we're really showing here with some other patterns. We'll modify this at some point, but clearly the ellipse is telling a very clear story. We're out of time, Andrew, so we need to wrap here. And I thank you for joining me this morning. And I hope in our next session we can talk in detail what your charts of triggers are showing and whether they'll still be bearing out what we're talking about here this morning when we are able to do that show. So in closing, Andrew, could you tell our listeners learn more about some of the work that you're doing in the Triggers website?
Sure. The site is triggers.ca. We have updates twice a week on 7 majors that we just briefly talked about. And they, as you could see from our talk today, they all go hand in hand with Gordon's work and what he's doing. It's actually a top-down. We take his information and understanding where he's seeing on the global macro level, and then I try and bring that down another level and hopefully make it some useful information for people's due diligence when they're making their trading decisions.
Again, thank you, Andrew, and looking forward to our next session. We can go through some of those charts. In closing, I'd like to take a moment as a reminder to our listeners, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and may 2013 be an outstanding investment year for you. Thank you very much.
Thank you, Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.